we're starting to see the shift in how different pools of institutional capital think about this space. Historically, you don't see too much active deployment of capital. Mainly index funds, passive investors have been in Bitcoin miners and the likes. I think what we have seen is those Bitcoin mining companies that are also pursuing an AI HPC strategy as well. They are the ones that have been most successful at diversifying their investor base and bringing some of these blue chip names in. I think one of the biggest stories recently has been,
when we look at the Bitcoin mining landscape, how do you think about differentiating yourself, or what part of the market you guys occupy, and what your North Star is?
So we're actually at kind of the verge in a new strategy we're employing here. I think what's very exciting and valuable about Riot is what Bitcoin has done for us. Bitcoin has served as this, I think to borrow from Michael Saylor, this nuclear reactor that has helped us grow. It's created this asset base, both in the form of the Bitcoin that we hold on our balance sheet. We've been growing that for 7 years now. And in the form of the power assets that we've been able to procure in pursuit of our Bitcoin mining strategy. So we've built up this enormous asset base that is compounding along with Bitcoin's growth. I think one of the differentiating factors for Riot now is that in addition to having this Bitcoin component, we are now looking at ways to leverage our power resources even further. A very common theme in the market these days is the rapid growth of generative AI data centers, cloud computing data centers, and the incredible constraint on power in order to make that happen. There's this real arms race. People talk about the arms race in Bitcoin mining. It's really nothing compared to the arms race that's going on in AI and the data center development needed to support that. So what we're now doing is we have real premier power assets located in major markets with the attributes that hyperscalers are looking for. And we are looking to build out this business line now, leveraging those assets. So it's a real, I think, new approach that we're seeing in this sector, where we both have this Bitcoin component. We're compounding our Bitcoin balance, using our low-cost mining operations, but at the same time positioning ourselves on the upside of this AI HPC sector. Two rapid growth sectors that we're pursuing simultaneously.
Talk about maybe the two major facilities that you guys have, or the energy kind of sources that you have in these major metros, and walk me through, on the HPC side, what does that look like?
So we have two flagship facilities in Texas. Our original facility was called Rockdale. It's about an hour outside of Austin, has 700 megawatts of developed capacity today, and it gets grid power. All the power you're going to find in Texas is grid power, a mix of a lot of renewables, but a lot of baseload nat gas generation as well. So we have a facility there, 200 acres, 700 megawatts of power. That is in operation today with all the water and dual fiber that's needed. And then our latest facility that we've been developing since really the end of 2021, so a long time coming, is called Corsicana. That's an hour outside of Dallas. And there we have a 1 gigawatt interconnect approved. We've built 400 megawatts that's in operation today, and we're building an additional 600 megawatts that's coming online in the beginning of 2026. Also, we have the water and fiber there. But just like Rockdale, that is an hour away from a major data center market. So when you think about the power demands that hyperscalers and AI companies need in order to succeed, these are two assets, particularly our Corsicana site, that fit that demand profile. So what we're trying to do is not necessarily build a data center and rent to a bunch of enterprise customers. That's kind of the traditional data center model that you see. We're looking to find a hyperscaler customer who's looking to take this capacity at a very attractive rate over a long term. That allows us to a blue chip counterparty where we can securitize the cash flows. And frankly, these are cash flows that the market is valuing really high. Data center REITs trade at 25x, 30x multiples, and we believe we have the assets to get there. So it's something new for us, but I think we've built an incredibly strong foundation in order to execute, and we're rapidly bringing in all the pieces together to make this happen.
When you have excess power or undeveloped power, but you're moving towards it, how do you decide Bitcoin mining versus the HPC? Is it just pure economics?
I think the first thing you have to look at is, does this site have the attributes that would make it valuable for an AI HPC data center? For example, we have operations in Kentucky as well. These are smaller operations spread out over an area. That's not something a hyperscaler would be looking at. So for us there, it's really no question. We can monetize stranded power with Bitcoin mining. That's the foundation that got us here. And what's interesting is, previously these sites were considered stranded power, and now they're in high demand. So we look at these, and the market today, because of the power constraints, is offering, at least with deals that we've seen signed in the market so far, generally economic terms that look very competitive, better than Bitcoin mining. But it's not just the revenue or margins that's important here. It's how the market values them. The market is valuing Bitcoin mining cash flows, for a multiple of 8 times right now. And like I said, data center REITs, trading at 20, 25x. And our peers that have first in this strategy trading at 20x forward multiple right now. So it's not just what you can get in that contract, it's how the market will value it. And that is what can help us create more shareholder value and allows us to execute on the other strategies we have as well.
When Bitcoin miners first came to the market, they were rightfully so very proud to be Bitcoin miners. And it was all about the consumption activity. It feels like the businesses that are saying, look, we're going to do Bitcoin mining, but we're also going to do the HPC work, they're almost like pulling back and saying, no, we're actually an energy company, right? It's more about what you're providing rather than how it's being consumed. Talk a little bit about kind of why that's occurring. Is it because people believe it's not just HPC, Bitcoin mining, there will be other use cases for this energy as well? Or do you think that it's just a cleaner way for the market to understand, hey, we do more than just one of these activities?
I think it comes down to simply maximizing the value of the assets, right? We're not being dogmatic about this. We are looking at our assets and we're looking at what is going to get the most shareholder value out of those assets. So if we see the excess power and the demand for that and see something that can monetize that at a higher value than Bitcoin mining, that's something that we want to pursue. Now, at the same time, we have this Bitcoin side of our business as well. This Bitcoin foundation, the growing Bitcoin balance, like MicroStrategy and others, Bitcoin yield is a metric that we're focused on. We generated a 39% Bitcoin yield, so increase in Bitcoin per share in 2024, and we're focused on that in 2025 as well. And it's really, we feel, as Bitcoin is unlocking these opportunities in other sectors. If it wasn't for what we were doing in Bitcoin and Bitcoin mining, we wouldn't have these assets and we wouldn't have them developed to the extent they are today that now have, valuable other use. So, hey, as a public company, our fiduciary duty is to our shareholders. We look at these assets and we're driven to see what we can get the most out of it. And that's what it is.
When you look at the regulatory environment, I think most people look at regulation and crypto, and it's everything that's non-Bitcoin. That's where a lot of the questions were. But miners have the energy regulation,
right,
is a huge component of what they're doing. Trump going into office, drill baby drill, energy deregulation. I mean, it was like every speech he was talking about this stuff. What are you seeing already change? And then what do you hope changes throughout this administration?
We're seeing a very dramatic shift as a result of the shifting political landscapes. If I was sitting here a year ago, and I did say this at panels I did a year ago, our industry was at an existential crisis. There was a cabal of government actors out there to absolutely kill us. We were seeing it all over government. From some agencies you wouldn't expect. The FDIC is trying to debank or assist in debanking cryptocurrency-related companies. We saw the White House trying to implement taxes that would have taxed Bitcoin miners' energy out of being competitive. And we had the Department of Energy trying to collect sensitive, confidential information on how all Bitcoin miners are using energy. And as an industry, we pushed back on that. Riot led, along with other industry partners, a lawsuit against the Department of Energy to stop that. And we succeeded in federal court and got an injunction, and that stopped in its tracks. And that's the kind of stuff that we were facing. An industry being singled out for using energy for no reason other than what we were using the energy for. What kind of country is that? Energy is such a fundamental thing for human flourishing. Who is to decide who gets to use energy and what type of energy consumption could be, taxed? What's next? Websites that have unpopular thoughts or opinions, they don't get to have energy to operate their data centers. Businesses that go against the grain, they don't get energy to operate as well. This is a freedom of speech thing, and it was a huge existential threat this industry, not just Bitcoin mining, but Bitcoin and the cryptocurrency industry broadly was faced with. The presidential election and the other national elections around there completely changed this. We saw the attitude change from a lot of state lawmakers even when they saw the tide changing because of the Trump administration's pro-Bitcoin position. Now, it's something that legislators still have an obligation to look at, how the energy grid in their jurisdiction is functioning, what types of market tools are needed to ensure a reliable grid. But the shift has been dramatic. So I think we're in a much better place. We don't take it for granted. We still do an incredible amount of work and lobbying and public policy. But we feel like we're operating more like a normal company at this point.
When you see that kind of sea change in regulation and in the political arena, what do you do differently now, right? It's one thing when it's, hey, I've got this huge headwind, and if the headwind becomes a tailwind, I can just keep going down the road. But it's another thing if you say, okay, now that I don't have that headwind, I can actually do things that I previously maybe thought I couldn't do, or there's opportunities that now are available. And so are you changing any strategies or anything internally because of the change in regulation?
I think what it does, it gives more certainty to the deployment of capital. When we build these facilities, we are thinking multi-decade timelines here. There's bigger expense up front to build out the campus infrastructure, but we're thinking about generations of miners, or now multi-decades of AI HPC use that would be utilized there. So to know that there is a much less chance of, for lack of a better phrase, the rug being pulled on us, that gives us a lot more certainty in capital deployment. And then in turn, that makes a lot of other things easier. It makes it easier to work with strong counterparties, strong partners in achieving your mission. I'll tell you, when Riot was first doing this 7 years ago, basic things became very hard. Very few, if any, investment banks would want to work with us. Law firms wouldn't want to work with us. Different vendors, partnerships that we had were falling apart because everyone was afraid of this industry because of the political and regulatory uncertainty around it. With that eliminated, it really, I guess what I'm coming at is it makes us stronger what we do. We're able to bring in stronger team members internally. We're able to work with stronger external partners, and it just makes the execution of our strategy that more certain.
Do you see a change in shareholder behavior now that it seems like there's going to be energy deregulation, there's more pro-Bitcoin political kind of apparatus? Certainty for the company deploying capital obviously makes sense. Mm-hmm. What about on the other side? Like the people who are putting capital with these companies, is there more certainty and more excitement there?
I do think we're starting to see the shift in how different pools of institutional capital think about this space. Historically, you don't see too much active deployment of capital. Mainly index funds, passive investors have been in Bitcoin miners and the likes. I think what we have seen is those Bitcoin mining companies that are also pursuing an AI HPC strategy as well, they are the ones that have been most successful at diversifying their investor base and bringing some of these blue chip names in. I think one of the biggest stories recently has been Cypher Mining and the private placement that they did with SoftBank. I mean, talk about a major institution bringing $50 million into that company. I think that was a landmark thing, and I think that's kind of maybe somewhat of a watershed moment of the type of capital that is coming into this space now.
When you look at these facilities, operating the Bitcoin mining sites themselves, there's been a ton of critics and even politicians who have said there's too much noise, there's pollution, there's not as many jobs being created as previously thought. Mm-hmm. How do you think about maybe like what do the critics get right where you're like, hey, Bitcoin mining as an industry needs to improve in these areas? And then what do you think that they're actually wrong about and they're just manipulating data or trying to unfairly attack the industry?
It's no secret that Bitcoin ETFs have taken Wall Street by storm. With over $35 billion in assets in just 1 year, it's become the most successful ETF launch in history. My partner Bitwise is the first and only Bitcoin ETF provider to openly publish its Bitcoin wallet addresses, allowing anyone to verify the fund's holdings. I believe this level of transparency is exactly the kind of innovation that only crypto makes possible. Bitwise is also the only ETF issuer that is a crypto specialist asset manager, meaning their team solely focuses on Bitcoin and they have the research, education, and support to help investors navigate the space with confidence. All of that is great, but what I love most about Bitwise is probably their commitment to developers. Bitwise donates 10% of their ETF's profits to Bitcoin open source developers. Bitcoin developers are the unsung heroes, working tirelessly to maintain, improve, and innovate the blockchain. Their efforts ensure that Bitcoin remains true to its promise as a decentralized system that is built to last. Go to bitwisepomp.com to learn more about their ETF and other services. Once again, that's bitwisepomp.com. bitwisepomp.com. As always, remember investing is risky and carefully consider the extreme risks associated with crypto before you invest. Today's episode is brought to you by Reed Smith. Their practice of law has the power to drive progress to move businesses forward and support them in achieving their goals. By seizing opportunities and overcoming obstacles, Reed Smith is focused on outcomes. I personally use them as my law firm, and I think that they are fantastic. They know that your time is valuable and that your matters are important. Their deep industry knowledge, long-standing relationships, and collaborative structure make them the go-to partner for complex disputes, transactions, and regulatory matters. Reed Smith delivers purposeful, highly engaged client service that drives progress for your business. Go to reedsmith.com to learn more about the best lawyers in the game. reedsmith.com. Go check them out today.
There's certainly a lot of manipulation, and I think there are a good amount of special interest groups, and I don't always know what drives them, but they drive a lot of this FUD, if you would, about Bitcoin mining. You hear noise complaints. Hey, our facilities our air-cooled facilities are far away from any residential properties, but I stand at our facility and I stand outside and it's really not that loud, right? Like people talk about low frequency noise, whatever. We're in New York City, right? Like with trucks and ACs, all like how much low frequency vibrations do you think are going on around here? So I think it's largely overstated. I think nonetheless the industry is getting better at insulating itself from these types of criticisms. People are getting better at noise control. The use of immersion cooling and liquid cooling obviously takes noise down a lot. One of the things that we did when we came in with our Corsicana facility is we were building that with 100% immersion. And that was a big undertaking. We built a 400 megawatt immersion facility, the construction side of which took place in under a year. No one's ever built, as far as I'm aware, 400 megawatts of immersion cooled infrastructure. And we did it, both for operational and financial reasons, but also to make sure that we were protecting from any potential criticism around that. As far as the water use goes, that's a criticism data centers more broadly face. Bitcoin miners use a fraction of the water that data centers use. Nonetheless, we have seen substantial improvement in that over the recent years. As we have different vendors competing for our business on the immersion side, the immersion does use some water for cooling, and we've seen water consumption go down over 50% in a very short time period. So there's a lot of motivation, not just in Bitcoin mining, but in the data center space to get this a lot better. Now, as far as you asked, what do these critics get right? Generally not a whole lot, to be honest. I can't really give them any credit. I think historically, Bitcoin mining operations have maybe been a little crude in just their appearance. And I think we're at a phase of really the kind of industrial scale institutional development of Bitcoin mining now, where you're seeing these facilities look a lot more clean, a lot more professional. At Riot, we take things like safety and security very seriously. We do not ever want to put anyone or anything at risk, and we've built out a safety program befitting a very large company in order to enforce that. So I think the industry is getting a lot of things right. I think there's always room for improvement, but we've come a long ways.
renewable energy, the last numbers that I saw, I think that over 60% of the energy mix was coming from renewable, or around 60%. The average American industry is at like 18%, which would suggest that Bitcoin mining uses 3 times as much renewable in their energy mix as the average American industry. Why is that not held up as, the example? That what every industry should try to do is get to over 50% renewables versus kind of the standard 18%.
That's something I have been shouting from the rooftops for some 5 years, and people are still skeptical about that figure. And the reason is they don't understand how it happens. The Bitcoin mining industry isn't 50 to 60% renewable because we're out there buying RECs and different types of renewable credits. It's that way because Bitcoin mining has been capturing stranded energy. Stranded energy is renewable energy. It would be very scarce to find some nuclear nat gas plant, while they exist. Generally, there's not a ton of stranded nat gas power that's not being used, at least once a generation facility has been constructed on that. The surplus energy is from this wind that is blowing and generating power at night when no one's using it, or the solar that's generating power during the day in hours that are not using it. That's where Bitcoin miners are coming to solve a problem. Texas has some 45%, I think now, wind generation in its generation fuel mix. Solar, I don't know the latest number. It's over 10, probably going on 20% now. And at the same time, Texas is some 15% of all Bitcoin mining globally. Bitcoin mining is helping solve supply-demand imbalances in energy in Texas, and it's also doing that all over the world. So it's because Bitcoin mining is location agnostic, because it's interruptible, it is able to consume more energy and solve these real energy problems. And I think it's something the industry should be proud of, and I think it's something that should be noticed more.
When you have capital, you now have a couple of different options. You can invest more to mine Bitcoin, get it onto the balance sheet. You can buy Bitcoin, put it on your balance sheet. You can invest in the HPC work that you're doing. And there probably will be other things in the future that you can kind of add in. But specifically on buying Bitcoin versus mining Bitcoin, how do you think about the trade-offs there and kind of a one-time purchase for future appreciation versus investing in, let's say, infrastructure that then can mine for some number of years?
Yeah, of course, capital allocation is one of the key decisions management teams and boards are always making. At Riot, what we do is we use our Bitcoin mining operations to effectively buy Bitcoin. And because of our low direct cost of production, because of the low cost of power we're able to achieve, 3.4 cents per kilowatt hour all in 2024, what we're effectively doing with our mining operations is dollar cost averaging into Bitcoin every single day. For most all of 2024, except for a few beginning weeks in the year, we retained all of the Bitcoin that we mined onto our balance sheet. We also issued our first convertible note, and with the net proceeds of around $570 million, we bought Bitcoin with that. So we added over 10,000 Bitcoin to our balance sheet in 2024 after starting with a little over 7,000. That's how we generated this Bitcoin yield alongside equity issuance that we had to support all of that. So I think what you see Riot doing is leveraging its low-cost mining operations to add Bitcoin to the balance sheet gradually over time, and effectively doing so with our low direct costs at a cost less than the market price of Bitcoin. And that is the most accretive way that we have found to add Bitcoin to our balance sheet, in addition to the convertible note. Great opportunity, something that MicroStrategy has certainly led the way on. Very low cost of capital route to add Bitcoin. We did a convertible note with a 75 basis point coupon that matures in 5 years. And the way Bitcoin performs, that's a very comfortable time to maturity that we felt we could deploy that capital to Bitcoin behind. So it's really using the tools that are uniquely available to us to buy Bitcoin, not just going out there and buying it in a vacuum.
When you think about the business, a big focus, I think, for you all has been driving efficiency. Talk a little bit about like what does that mean, and then what are the things that you guys have done so far that has gotten you the most gain in efficiency, right? Because it's a lot of different actions you have to take, but what have been like the big winners or the big areas where you've made up some room on the efficiency front?
Yeah, my mind goes 3 different directions when you ask that. I think about efficiency from a power perspective. I think about an efficiency from a machine perspective. And I think about efficiency from an operating perspective. I think Riot has really led the pack in our power strategy. We've assembled a very strong capability in both procuring power, but also executing on an ongoing power strategy. What we've done with procuring power hedges, participating in ancillary service and demand response programs in ERCOT and other grids now is what has driven that low energy cost. And that is the key input cost for Bitcoin miners. So if you are exceptionally good at your energy cost, you are going to be an efficient producer. And that makes machine efficiency, how much joules per terahash a machine requires to generate hash rate, that makes that less important, still important, and for that we've been driving, procuring the latest generation equipment. But operating efficiency and how you execute there, I think is really important too, especially because Riot and others are doing this at a scale that's never been done before. There's been so much growth in Bitcoin mining over the last year. We're operating now these multi-100 megawatt sites. Very few of those exist. And operating things at scale, it's a lot more difficult to operate 400 megawatts, 700 megawatts than it is 4 or 7 megawatts. And the complexity scale is a little different than what you might think. And the way we've driven efficiency there is finding good people and empowering them to make decisions. It's something we talk a lot about is decentralized command, and giving stakeholders the ability to drive decisions up the chain. It's not a top-down approach in how we're going to accomplish something. It's putting the input and decision-making to those on the ground that know it best. And I feel like what we have seen is empowering leaders on the ground drives better results.
When you're watching this all play out, Bitcoin's price has been going up for the last year. That's good news. When you see the Bitcoin price go down, miners historically have had a lot of pain. HPC seems to be diversifying a little bit of that cyclicality. What else have you guys learned about how to deal with the bear markets? And do you expect a bear market to still happen in these kind of 4-year cycles?
I don't know what the future will look like. The 4-year cycles are certainly clear to see looking back on the charts now. I would like to think that the increased adoption and the changing political and regulatory landscape should dampen the downturns. And you think about the downturns we've encountered in the past, there's always been a sense of, is this it, right? Like, people wondered, FTX goes down, 3 Arrows Capital. People are like, is this it? Is this the end of the industry? Going back, Chinese Bitcoin ban, is this it? Mount Gox going down. People wonder, is this the end of the whole industry? So these things have happened in the past that have felt existential. And every time we make these new leaps and reach new heights with this industry, I think we reduce that risk. But for us at Riot, the key thing that we have found to withstand this volatility is balance sheet strength. We've always prioritized having a lot of cash on the balance sheet, having Bitcoin on the balance sheet, and keeping debt very manageable in order to ensure that we can make it through this volatility and reach the long term. I have no doubt in Bitcoin's success long term. I have no doubt at all. So what we need to do as a company is get there. Historically, we've had no long-term debt. The convertible debt, I think unique product that we felt very comfortable with, especially its size relative to our asset base and the amount of Bitcoin that we've held. But we continue to prioritize keeping a strong cash balance, understanding that we need to make it through all market conditions, not just the best ones or not just the normal ones.
Innovation is really the name of the game in mining. You have innovation on hardware. You guys mentioned building out the infrastructure for the energy itself. I would even argue the innovative business models that people are starting to kind of pursue and figure out how to do this. What are the areas of innovation that either you guys are working on that you're excited about, or areas where you say, hey, there hasn't been enough innovation here, and that's something that we are looking for people who can go solve these problems?
I think the immersion cooling is a key area that Riot has focused on, perhaps as much as anyone, because we first built our large-scale immersion cooling in 2021. We announced 200 megawatts of immersion. At that time, that was the biggest immersion deployment ever made. We learned a lot from that. And when we built our new facility at Corsicana, we're like, now we're going to build 400 megawatts. And in fact, we were originally looking to build 1 gigawatt of immersion at that site. So there was a lot of innovation involved, working with partners to make this better and better. For example, we talked about the water efficiency improvements. That was important. We have felt that immersion cooling is a really important technology to keep machines operating at stable temperatures in order to prolong their useful life. I think, especially with what we're able to achieve with a low cost of power, we can get a lot out of machines for a very long time as long as they continue operating. Hash rate, mining hardware, that's the #1 expense that a Bitcoin miner has. And I think our innovation here is going to help prolong miner machine life cycles. We depreciate them on a 3-year schedule on our financials. That's more accounting driven. But we believe that we can get much more time out of them. And I think that's going to be a very important part to being competitive in Bitcoin mining, to drive a strong return on capital, because it's going to reduce the amount of machine refreshes you ultimately have to do. And that it's very important. That's coupled with the strong power strategy as well. By keeping that power cost low, doing things in demand response programs helps you achieve that. So similarly extends the competitive life of those machines.
Do the other miners help you, or do they hurt you when it comes to capital markets? And this is something that I've thought a lot about. If there's this classic restaurant problem, if you have one restaurant in an intersection, it does okay. If you put a second one, everyone always thinks the second one puts the first one out of business. But what studies show is the more density you get at the intersection, then that kind of becomes like, what do you want to eat? Let's just go down to the corner and we'll figure out what restaurant we want to go to. Is that what's happening in the capital markets with miners? Is as there's been more miners who have had success, capital markets are becoming more familiar? Or do you see it being more of a zero-sum game from an investment standpoint?
I think it is something that the market has become more familiar with, right? There's a ton of there's a ton of investment bank coverage of this space now, of lots of different miners. I do think that the space is a bit more wide than it will be long term. There's a lot of capital obviously flowing around this space. I still think it's often difficult for investors to differentiate between these different companies and decide, which one is better for me, which one has the best long-term value proposition. So while this is a theme we've talked about on fireside chats like these for a while, I do believe there will be industry consolidation over time. But I believe alongside that will be, an increasing flow of capital into this space. There's been a good amount of miners in the public markets, for a while. I believe Riot was, I won't say the first in case I'm wrong, but at least one of the first Bitcoin miners on NASDAQ back in 2017. We've been doing this for a while. And there's been a number of names around the same time period. And we see, more de-SPACs and IPOs kind of every year now. So I think there's a bit of an education that's going on in the market right now, and over the long term, we'll see more consolidation amongst those options. But it's overall good because it's driving competition, which is driving management teams to get to better results.
Ladies and gentlemen, Jason Liss, Riot CEO.
Thank you.
Thank you. Appreciate it, man.